A very welcome to all the viewers of this webinar. My name is Mukta Kathuria Verma, and I'm the Secretary to the Committee on International Taxation of ICI. On behalf of the committee, I welcome you all to this webinar, which is being, talked about by the expert. We have with us Mr. S.P. Singh, who will be on behalf of the International Taxation Committee on International Taxation. His name actually doesn't require any introduction. He now the viewers of international taxation already well acquainted that he's been associated with ICI. And over to you, sir. Please.
Thank you, Mukta. Good afternoon to all the viewers and the keen learners of international taxation. It's a great honor for me to start this discussion. When I was thinking about all the issues which Rashmin and Akhilesh, PVS and Amia are going to talk to you, I was reminded whether we are in the best of the time or we are in the worst of the time. There may be dispute, but there cannot be dispute about one thing, that we are in the most interesting time. Things are happening so fast in all spheres of life, as if there is not going to be tomorrow. The way digitalization and globalization, which are not new things, but the pace at which these two are happening is really, really something which the world had never experienced. Gone are the days when we all had to physically assemble in one place to listen to the four luminaries, participate with them, put our questions. Now, in the webcast, virtually, we are talking to them, we are listening to them, and that is going to increase our knowledge. This has percolated, this has touched each and every sphere of our life. It is something which is ubiquitous. Taxation is not safe, or is not untouched by the revolutions which are taking place in technology. But they are all the stakeholders, whether the business people, whether the tax administration or the tax advisors, are really feeling that technology is walking in front of them. They're used to be saying that tax administration is always one step behind their tax advisors or their the business people. But now technology has taken over everybody. The things which are happening do not require the physical presence in any location. The money, labor, advice, technology, all those are moving across the globe seamlessly. It appears as if space and time have been squeezed to such an extent that there is no difference between one location and the other, one time frame and the other. The time has really become circular rather than linear. In this time, the issues regarding transactions through the digital means is drawing the attention of everybody. We all are keen to know about what are the things which are happening. And fortunately, we have four panelists. Rashmin will be the moderator. He doesn't need any introduction. If you want to know something which is not being said or which is different, listen to Rashmin. He comes out with really piercing analysis of topics on international taxation, foreign exchange management act, and other things. He's always present, and he's one of the persons who always supports ICAI, or rather I would say, who always supports growth and spreading of knowledge across all spheres. The next one today with us is Akhilesh Ranjan. I think Akhilesh is a name in itself. He has been with the tax department for several decades. I won't put the numbers. It doesn't look like that. He has been involved in the development of tax policies, not of India, but global. He has been associated with OECD, G24, and other. But his contribution to the development of international taxation is really unmatched. Everybody looks to him. If you want a very fair and frank opinion, always rush to Akhilesh. Then we have PVS, who carries experience not only as advisor, he had long in him as actually a person who has implemented the advices, who has implemented the policies led by the government. He has been actively associated with formulation of tax policies. His hand-on experience on HNI family wealth management and monitoring corporate law compliance is something which is really remarkable. And we have evergreen and always vibrant with energy, Amia. He has long experience in the area of sharing information, sharing knowledge, and now he is a tax advisor, but his presence ensures that the developments which are happening across the globe are brought on the table for all of us to see, to actually appreciate and put questions to him. I once again thanks all the four panelists, and I'm sure that today all of us are going to be immensely benefited by the discussion, because the topic which has been selected by them is very, very interesting, very real, and it's going to involve us in the future for long many years. Formulation of policy is one. Appreciating the reason for formulating a policy is very important, and how it is going to be implemented is the one where it's the icing on the cake. So we have all the panelists with necessary experience, and with this, I hand over to Rashmin to carry on the discussion. Thank you.
Namaskar, Singh Saab. Many thanks to you for your kind words, and thanks to the Institute that we keep discussing the latest in the legal technology. Friends, today we will be discussing digital taxation, and on the Institute platform we have discussed this subject several times at conceptual level or theoretical level. Today what we have thought about is look at the businessman, the company or the SSC who receives revenue, and the person who is paying that kind of charges, digital commerce charges. How would they know whether just a moment. So the point is, while I am trying to share the screen, the issue is, if I have to make payment for digital charges, how do I apply, which law should I apply? And if I am going to earn digital revenue, how much tax I would be paying? That is the whole sidetrack. That is the whole issue. That is a real practical issue. I am making a payment today of rupees 1 lakh to Amazon or Google or Facebook or anybody. Should I deduct 2% tax? Should I deduct 10% tax? There are 4 different provisions in the Income Tax Act itself. And then there is double tax avoidance agreement. So most tax consultants, including even tax officers, get confused what law should be applied. So today all 4 of us, in fact all 5 of us, where while Mr. Singh is not a panelist, he is an acknowledged expert on international taxation because he has exposure from the department also and profession also. So all five of us will share our views with you. The point which I want to highlight is we want to look at the practical issue. Okay, so for that, a few case studies, very simple case studies have been prepared to show whether treaty will apply or not. If treaty does not apply, which kind of provision will apply, that everything we will be seeing. So what are the applicable provisions? One is OECD has come out with Pillar 1 and Pillar 2, and just a moment's history that OECD has been discussing digital taxation from 1997. Sorry, 1 minute. It is not appearing? What screen is not appearing?
So just stop sharing.
Yeah. Sorry, I think participants are not able to see the screen. I will do it again. Can you see the screen again? Okay, okay. Yeah. Okay, so finally from 1997 to 2021, after 24 years discussion, in October 2021, OECD came out with Pillar 1 and Pillar 2. How are they going to affect Indian taxing rights and Indian SS's tax liability? That is what we will discuss. Then within Indian Income Tax Act, there is significant economic presence, equalization levy, virtual digital assets tax, and as well as royalty in FTA. So let us examine and compare these things. There are some short forms which we are going to use, but participants little later can also have a look. So since conceptual issues have been already discussed, very briefly I am just mentioning here that for proper taxation, you need a nexus. Any government, say government of India wants to tax a non-resident, his income. Now we can tax only if we have a nexus. So far there were only two nexus recognized. One was residence of the SSC, that determines the country of residence. Second was source of income. Now source of income determines country of source, but both these factors are supply side factors, meaning they are concerning the SSC who is selling goods or providing services. Now the third nexus which has been accepted officially by the OECD is country of market. In fact, from 1997 to 2020, we have not accepted country of market as a, meaning OECD did not accept country of market as a third nexus. Whereas India had proposed it in equalization levy of 2016, we said the entire equalization levy, we do not require any connection with the SAC, the supplier of goods or services. Just because India is a market, India has a right to tax. Now this has, now that OECD has accepted the concept, it has very important implications as far as drafting of the law is concerned, that we will see little later. The another aspect, which is a fundamental aspect in international taxation, is that if any government wants to tax an income, then it first needs nexus which we have just seen in the earlier slide, and then comes attribution of taxable income or attribution of profits, because these global corporations earn revenue from several countries. Now we cannot tax a company's income just because it is selling goods in India or services in India. There has to be a proper attribution. Now I have my very good friends in the income tax department who have been making assessments of permanent establishments, and they say that attribution of profits even for the established concept of permanent establishment is a very vague concept. Now when it comes to digital taxation, it becomes even more difficult. How do you determine what kind of profits will be attributed to country of market? Now, permanent establishment, of course, is irrelevant as far as digital taxation is concerned. There is one small, on interpretation of law, I will make one submission here. We chartered accountants generally jump straight away to interpretation of law. Actually, a good method of interpreting the law or understanding the exposure to taxation would be like this. Instead of straight jumping to the interpretation, we should know the background. Why this law has been drafted, what made it necessary. Then who has put up the draft proposal, what will be the consequences, and what really should be a good law. If we can look at it from all these perspectives, and my one very senior counsel tells me that late Mr. Palkhiwala used to look at all these aspects, and when he would argue before a court of law, and if he would show that the consequences would be unreasonable, then the judge's opinion would change depending upon the consequences also. And today we will try to look at the consequences of the Pillar 1 and Pillar 2 proposed by OECD. In case of digital taxation, this has been discussed earlier, that US is the main country of residence because it is most of the MNCs from USA who earn global revenues. They do not need their permanent establishments outside either USA or tax haven like Ireland. So they pay tax either to USA or they park their funds in tax havens. But they were trying to pay zero tax or minimum tax to the country of market. And that is why UK and France, these are the two countries which realized that they are not getting appropriate share of tax revenue. So at their instance, OECD started the BEPS program under which digital taxation was being discussed under Action 1. Now, if the BEPS program would be successful, meaning Action 1 program would be successful, it would mean that the countries of market would be able to tax digital corporations. If they tax digital corporations, naturally, USA being the country of residence would have to give a credit or a set-off for the taxes paid abroad. This would clearly mean that US government would lose certain revenue, and that is why USA as a party to the BEPS negotiations was raising several objections, and the BEPS negotiation which were digital commerce proposal which should have come in the year 2014 has not been finalized even as on today. There are proposals, these are only proposals, tax system has not yet been finalized. And we have seen that while OECD has been negotiating the year 2021, for anybody who could have deep insight into every reports being published, it was clear that USA did not like the Pillar 1 proposal as originally put up. The president of USA objected to it, and then OECD could not proceed further. Finally, the Pillar 1 which has come out, which really affects the digital taxation, is largely beneficial to USA, and the countries of market will get hardly anything. Now, we have a stalwart amongst us, Mr. Akhilesh Ranjan, who has been party to the BEPS discussions for a very long period. Now, we all see that while OECD makes certain consultations, certain drafts public, initially in the years 2013-14, when Action 1 program was being discussed, it was not open to us. In fact, participants in the BEPS discussions were not supposed to reveal what was being discussed. Now, some philosophers say that justice and democracy die in secrecy, and that is why all our courts of law hold open sessions. Even Parliament holds open sessions. On the television we can see what is going on in the Parliament. Akhilesh ji, can you please explain to us why the BEPS group accepted secrecy?
Okay, thank you, Roshan Bhai, for that question and for the introduction. You see, I mean, as you have mentioned, it has taken the world more than 20 years of discussion to try and resolve some part of this problem. And the reasons for that were obviously because the rules of source and residence, as you have talked about, which were established in the 1920s, had been holding sway for such a long time, it is extremely difficult to make any modification. The first serious attempt to bring in tax reform was the BEPS 1.0 program of 2013, which is what you mentioned. Now, if you go back to that time, it was not merely an OECD endeavor. The OECD could undertake the BEPS project only because it had the political backing of the G20 nations. It was the first time that the G20 or these larger economies got together and said, okay, we must do some reform. And that's why the manner in which the discussions would take place, how the reports would be generated, all that was not established, not clear. It was known that many countries will have widely divergent views, and I have been party to those discussions out there where we have had violent disagreements between India and US with other countries. So there were firmly established viewpoints which would take a lot of time to change, and that's why the discussions which were happened, and the discussion happened in different forums in the BEPS project. For example, there was a task force on digital economy. It's still there. Main Action 1 discussions took place there. It was co-chaired by the US, of course, but then India was a member of that. Then final decision making would happen in a bureau, where again there were about 20 countries or 15 countries who would discuss and decide. So there had to be some sort of a keeping things close. Because if you start consulting right from the beginning, there will be no answers. I mean, there will be so much of confusion. So it was not just a total secrecy rule, really, but it was something that countries thought it is best to try and discuss and find some solution, some meeting ground, and then talk of consultation. I think that was the main reason for the so-called secrecy. Of course, I will also add that since it was a project which was being run essentially by the OECD, the OECD member countries did have their own discussions, internal discussions, prior to the meetings of the BEPS project. And those discussions, of course, were not known to anyone outside the OECD countries. So when we joined in as India, Brazil, South Africa, the non-OECD countries, because we were part of G20, we joined the discussions. No, we were not able to know what the OECD countries had already thought about or discussed. So I think to that extent, yes, there was secrecy, but as I said, it was something. It was a new project. It was a new sort of way of trying to achieve consensus, and I think that's why countries went along with it and said, okay, let's find some meeting ground and then we will discuss with the world. I think that's why.
Yes, sir. Thank you, Akhilesh ji. So, as I said, since USA found itself to be on a losing ground, meaning not allowing countries of market to tax anything, so there were so many arguments. Luckily, I was party to the e-commerce committee of the year 99-2000. Even there, we had seen that whatever proposals were put up, they were objected to by OECD. Finally, by 2015, countries realized that there is no progress happening at OECD. So Britain came out with diverted profits tax, meaning government started ignoring OECD and started bringing out their own unilateral digital taxation. We in India came out with equalization levy. European Union, there was a lot of discussion on significant economic presence, and they proposed ACP as an alternative to the established permanent establishment. Now, when so many things were happening, so many countries were eager to start their own digital tax law, that is when President of USA, I think it was a very famous statement, Mr. Trump made a statement that OECD proposals are not acceptable to USA, and then there was a big chaos, and finally US, even after President Trump retired and President Biden came, the USTR action continued, and under USTR, US government threatened every country which had brought out their own digital tax law. They were all threatened with trade war or other sanctions. And today what we have is the most vocal country like Britain and France, who were objecting to the old traditional OECD, they have almost gone silent, and OECD claims that 137 countries have unanimously accepted Pillars 1 and Pillar 2. Now let us see about Pillars 1 and Pillars 2. One thing I would say that if these Pillars 1 and Pillars 2 are because of coercion, because of the threat of trade war, then at least what I have studied about Indian Contract Act, a contract signed under duress or coercion is voidable contract. So this OECD statement on Pillar 1 and Pillar 2, I don't know how long they will be sustained. I have my own serious doubts about it. At this stage, sir, Akhilesh ji, I would request, because you are privy to the maximum information about Pillar 1, Pillar 2 and their developments even after October. So would you like to share some information about Pillar 1 and Pillar 2 with our participants?
Okay, yes, of course, I think this very august audience would already be aware of the basics of what Pillar 1 and Pillar 2 are all about. But very, very briefly, as Rashman mentioned, there was a time when a number of countries wanted solutions, and they were going ahead with their own unilateral measures, trying to protect and preserve their own tax bases. So UK wanted a diverted profits tax, the EU thought of the significant digital presence, India came up with the equalization levy. So every country was sort of claiming that I have a right to tax at least a part of this income, which till then, because of the current international tax rules of which required physical presence and business nexus, no, these countries were not able to tax. So ultimately, there were 2 or 3 approaches suggested by some countries, including from India. The developing countries also suggested their own approaches to how to resolve these issues, and then the OECD formulated a unified approach comprising of 2 pillars. The proposals at that time were of different types. One was basically saying that some profit should be allocated to the market jurisdictions because the markets do contribute to the earning of profits, and that was a major sort of breakthrough in international thinking. And then there was a large group of countries which thought that the digital tax problem could be resolved by having a minimum global tax. Because these countries, they said that the problem with digital economy is that profits can be diverted very easily to low tax jurisdictions. And so if we have a global minimum tax, then enterprises will not be able to shift profits, and the main issues or problems of digital taxation will disappear. Well, none of these approaches were absolutely correct or complete, but the unified approach then talked of these 2 pillars. One pillar, then Pillar 1, essentially saying that, all right, we will identify some part of the profit of large profit-earning corporations and allocate that profit to market economies, even if these enterprises do not have a physical presence in those market economies. So in a sense, this Pillar 1 talked about a new nexus, which would be created by the market. And secondly, it talked about a new way of allocating income, not by normal transfer pricing rules, but by a sort of formulary approach. Then, okay, we will identify some percentage of profit, and then we'll take some basis for allocating, and we will give some profit to all the market jurisdictions wherever the sales are happening. So that was the basis of Pillar 1. Pillar 2 continued with the global minimum tax proposal. And this sort of said that, look, every enterprise must pay a certain minimum amount of tax. Now, obviously, considering the sovereignty of countries, we could not, or nobody could impose or force countries to adopt a certain tax rate. If my country does not want to tax its citizens, then who is the world to tell me that I should tax them at a minimum rate? So there's an issue of sovereignty in taxation out there. So the solution then was that, okay, we will let countries have their own rules, but multinational enterprises will have to pay a certain minimum tax on the profits that they make in each jurisdiction. So if company A makes certain profit in India, then it must pay a certain minimum tax on that profit. And in spite of all the exemptions and incentives and low tax rates, a minimum tax must be there. So that is essentially pillar 2. It says this minimum tax is sought to be imposed in a variety of ways. It is essentially an accounting exercise, where you first determine what is the total profit. Then we determine the effective tax rate in each jurisdiction. And if that effective tax rate in each jurisdiction is coming to be less than a certain figure, which is 15%, then a top-up tax will be levied in different ways, either by the country of headquarters of that enterprise or by other entities of the group which follow the under-tax payment rule. So various rules have been devised, and I'm not going to go into the details of the rules. They are extremely complex. But the end result of that is that somehow, in one way or the other, the profit of a multinational enterprise in a particular country will be taxed at a minimum of 15%. By whom and at what stage? So that's the content of the rules and the complexity of the whole proposal. But the basic idea is this. So this is what Pillar 1 and Pillar 2 is essentially the agreement on. There are a large number of very complex areas which are still being worked out. In Pillar 1, for example, it is important to know what is the basis for allocating the excess profits. First of all, of course, to determine the excess profit. What is that profit figure? Which accounting standards do you follow? Whose accounts do you see to determine that? And then how do you allocate that excess profit? If you go by revenue, then how do you compute the revenue? Rules. There is still debate going on. The OECD, many issues out there which are not clear. There are many comments made by the world players. So it's still being worked out as to how, supposing a sale, an intermediate product is sold in country A and the final product is sold in country B, where does the revenue come from A or from B? I mean, those are the sort of issues that have to be understood. Then there is the issue of what is the tax base? I mean, what is there what is the income that has to be allocated? There are issues of how do you eliminate double taxation, because transfer pricing and all still continue side by side. So there may be normal transfer pricing disputes on allocation of income. There may be a superimposed allocation of income under Pillar 1. How do they interact between themselves? What happens to the disputes generated? Who bears the tax, and how is double taxation avoided? So all these are several issues which are still being worked out. Pillar 2, on the other hand, also has its own issues, mainly the accounting issues. How do you compute consolidated profits? How do you compute the effective tax rate of each jurisdiction? And then how do you set up that system by which countries know that who is supposed to tax what income? So it's a complex exercise. Model rules have been brought out. Countries have been requested to try and incorporate them in their domestic legislation. There is a multilateral convention which is being drafted for Pillar 1. It will be open to all countries to sign that and enter into that agreement. All the various instruments now are being prepared for implementing these central agreements on Pillar 1, Pillar 2. But the basic idea of Pillar 1 and Pillar 2 is just this: allocation of income to market jurisdictions with a nexus out there, and a global minimum tax under Pillar 2.
Thank you, Akhilesh ji. Sir, can I also request you to give some comments on UN Article 12B, because there are two proposals. One is from United Nations, one is from OECD. India has always preferred the United Nations model, but now with signing this October statement, does India have an option to go for United Nations proposal? Can you please comment on it?
Yes, sir. So, to see what is the genesis of the UN proposal? These discussions on taxation in a digitalized economy actually started in 2016-17. But then, for some time, there was not much of headway. Also, many developing countries wanted a simple solution, not a very complex exercise of, how do you compute profits, how do you allocate, how do you find the ratios, what sort of cooperation is required. They wanted something simple and straightforward. Countries like India said, look, I know the sales in my country, I know the total profit of that enterprise, let me work out a formula which gives me an allocation of income on that basis, something called a fractional apportionment of income. But then these sort of simple approaches were not accepted in the discussions happening in the inclusive framework, and instead a unified approach which took portions of various proposals and put them into one single approach was then adopted. But in this whole process, countries, as I said, mainly developing countries, wanted a simplified approach. And that gave rise to this proposal to have Article 12B in the UN Model Convention. The idea for that, of course, is based on the Indian Equalization Levy of 2016, which was a straight levy on a percentage basis on the gross amount of revenue. But the UN article also talked about a way of estimating net basis income by deducting certain amounts and then applying a tax rate on that. So the UN Article 12B was something which met with the expectations of many developing countries. The problem with the UN proposal was twofold. One, that it talked about changes in bilateral tax treaties. It was attempting to solve a multilateral problem through a bilateral approach. And secondly, the fact that the UN Tax Committee, which does all the work in the UN, is not an intergovernmental body. It's a committee of experts, of individuals who are not acting on behalf of their governments. So the inclusive framework and the OECD, which actually is comprised of government representatives, obviously had more say in deciding what was to be agreed between nations. Now, India has been a major player in the inclusive framework in the discussions. The UN body, of course, as I said, is a committee of individual experts. The proposal, Article 12B, was in fact formulated and drafted by a person from India, a very good friend of ours, Mr. Rajat Bansal, you all know him, and some other people from Argentina and Nigeria. But they did it as individuals, whereas India, as a country, as a government, was part of the inclusive framework and agreed to the OECD Pillar 1 and Pillar 2 agreements. So, right now, the situation is that India stands by the Pillar 1 and Pillar 2 agreement of the OECD. That has been agreed to and signed on a government level. The UN model is something which India sympathizes with, is okay with that, but it's something which cannot coexist with Pillar 1. If Pillar 1 in its current form and the multilateral convention comes into existence, then India will sign that multilateral convention and ratify it, and then obviously will not make any effort to introduce Article 12B in its tax treaties. Of course, there are now new strains, new ideas, because there are apprehensions that the Pillar 1 agreement may not actually work out because of various resistances still from the US Congress and from other quarters. There is still some thinking that maybe the world will abandon Pillar 1 and come back to this simplified approach of Article 12B by giving it a more multilateral format. So these are things which can happen in the future. As I said, India is sympathetic with the Article 12B. This is something which meets developing country nations. But on a government level, India has agreed to the Pillar 1 right now. and it is pillar 1 that is being that will be implemented to the best possible extent.
Thank you, Akhileshji. If I can make a few observations, normally we have seen a tug of war between taxpayer and the tax officer. Now here we are seeing a tug of war amongst governments, US being on the one side and all other countries being on the other side. And it looks like the balance keeps changing. My second observation is the pillar 1 and pillar 2 look like so complex that for companies to comply with the same would be difficult, for tax officers to administer the law would be difficult. So it looks like not a simple and efficient measure of instrumentation of taxation, which the OECD had signed as Ottawa Agreement in 1998. So if we look at the Ottawa, they had specified that these should be the 4 conditions for a good law to be complied with. Then pillar 1 and pillar 2 failed miserably. I would not give them 10 out of 100 marks on the Ottawa criteria. But sir, we can go on like this. There are 4 Indian Income Tax Act issues to be considered. So let us look at them. We consider significant economic presence, and we have Mr. PVS Srinivas, who has been advising the largest software companies who are actually, so a software when it is made in India, whether Bangalore or Hyderabad, and it is served or it is operated on a server outside India, it is nothing but e-commerce or nothing but digital commerce. So Mr. Srinivas has got a tremendous knowledge of this subject, hands-on knowledge. Srinivas sir, would you like to make a few observations on significant economic presence? What is its position in our law today? Is it binding on me if I am a concerned SSE? What will be my situation? Can you please explain?
PVS sir, you're on mute. If you could unmute, please.
SEP, though is a very recent concept, it is to prepare the domestic law to accommodate the global developments which are happening. As we all know, the section 92 says that if the domestic law is more beneficial, that can be applied. So in order to remove the beneficial effect, if there's an amendment in the treaty tomorrow, and all these are allowed to be captured as a taxable event, the PE scope is amended, and all these concepts are implemented, then the domestic law also should have a corresponding change, which will be equal or even slightly larger than the what is accepted in the double taxation avoidance agreements. As he said, it could be a multilateral instrument or whatever. Finally, it has to get incorporated in the double taxation treaties. So 3 or 4 attempts have been made to incorporate what should be the language of the SEP. Each year you find a new draft, and but the thread of thought has been essentially the same. The government is trying to say we will divide the SEP into 2 parts. One dealing with transactions, where transactions have a payment to be made. The other to deal with activities which will be user-based. So there will be a transaction which will be for which a payment will be made. There will be users where there may not be a payment from India, but still India is contributing economically to the businesses of the overseas enterprises, and therefore a part of the profit should be taxed here. In transactions, you will find it is slightly wide. We have been talking under the caption of digital taxation today, but SEP does not limit itself to digital taxation. It covers sales, services or property. When a non-resident deals in a transaction with a resident anybody in India, then all these transactions would be liable to application of SEP. An amount of payment has been kept as a threshold. The government would prescribe the payment. Under the earlier law, the government had prescribed 2 crore as the aggregate payment. But nevertheless, this amount may be revised from time to time. That itself means the attraction of SEP would depend on how the government would fix the base limit subject to which the threshold exemption will be available or not. Likewise, users also is one of the criteria. Systematic accessing information users and getting information from the users, all of them will be liable to another activity which is SEP again. Here, there may not be a payment from the users. The users may not make a payment to the non-resident. Still, it will constitute a SEP. Here, the number of users would be the criteria. And again, the government has enabled itself to prescribe the number of users. And it would possibly prescribe. Last time we saw the rules, 3 lakh users was prescribed as a criteria. Again, who would be a user? All these definitions can come into a little amount of litigation. But essentially, the number has been fixed as 3 lakh users. And you will find that the user base as well as transaction base are covered. In a sense, the government is trying to equate business connection into SEP in a different form. It will possibly substitute business connection going forward for all transactions. If I have to say 2 or 3 things to be pointed out as controversies, if I have to say, in the drafting of the law, hopefully it will get corrected over a period of time. Now, when you say transaction can be a purchase transaction, it could be a sale transaction. When a non-resident purchases from India, that will also be a transaction. That also would result in a payment by the non-resident for the consideration to be paid to the Indian supplier, and therefore that would be a transaction. Is such transaction intended to be covered by SEP? The plain and simple strict reading of the law, it looks it's covered, but possibly the intention should be brought a little more closer, because we all know mere purchase of goods from India, if there is an Indian office which is established by a non-resident and the Indian office makes a purchase function and then exports the goods, then that would not constitute a business connection. There's already an explanation to that effect. Now, a direct import by the non-resident cannot be worse off than having an Indian office and purchasing the same activity. So I think my own gut feel is the scope has to be a little more narrower. Somewhere, if you strictly interpret, possibility is narrower. When you say transaction with maybe having sounding like a sale transaction rather than a purchase transaction. But we don't want courts to enter. We don't want Supreme Court to determine whether it's a purchase transaction or sale transaction. Possibly a little clarity is required to exclude purchase transactions and have only sales transaction. As we were earlier discussing, it is a market which is creating a nexus. Market itself means it's a market for sale of goods and services and property, and therefore scope of SEP also should be limited to the transactions of sale by the non-resident to an Indian purchaser, or the market being India. That will be one article. The second peculiar aspect which is very important is what will be the attribution principle which will be followed. Normally, if you look at 9.1, possibly you will find for the operations carried out in India only the profits can be attributed. For example, if digital product is sold in India, it will have an R&D, it will have a development, it will have cost of implementation, so many things will be incurred. Finally, the market is found in India for a moment. Now the market related profits cannot be the entire profits. It can be only those profits which are relatable to the marketing activity. And that is how the section 9.1 has been framed earlier, that those activities or the operations carried out in India, profits attributable, that activity alone will be liable to tax. But the way the law now has been captured, it looks that the entire profits attributable to the transaction with India will be liable to tax. So if the transaction in India, say $1,000 of sales to India results in $150 of profits, the entire profits would be subject to taxation under the domestic law, though the sales alone is taking place in India, remaining functions, etc. have happened outside India. Possibly a little clarity is required that you cannot have a profit to be taxed by one nexus doesn't mean that it pulls the entire profit into India for taxation. It must be only the attribution principle, functionality and other things will have to be maintained. So possibly the Indian law is worse than the OECD Pillar 1 and Pillar 2 which we talked earlier. Pillar 1 and Pillar 2 at least left something for India in a limited apportionment. Here is the reverse is happening, that India is possibly trying to pull the entire profit into India. Of course, if there is a treaty will limit the amount of profits which can be allocated under a different mechanism. But the domestic law is slightly wider than what it should have been. With these comments, I will put it back to Mr. Rashmin. There are two controversies which are there. If they are ironed out, possibly SCP is in line with international concepts. The third one is it has not been limited to digital transactions. It is slightly wider. It covers all goods and services. Maybe intended. The US also possibly looks at this kind of a model that they don't want to limit it to digital transactions. They want to be on trade. Large M&Es rather than M&Es dealing only with digital kind of a case.
Sir, many thanks to you, Srinivas sir. I'll just summarize your comments that when it comes to building the nexus, the Indian law wants to cover the entire gamut of cross-border transaction, cross-border business, import, export, goods and services, everything. Then when it comes to attribution of profit, we want to tax everything. Not only the sales function, but production, purchase, quality control, all the functions, the profits arising because of all the functions we want to tax. Do you think this is a constitutionally valid kind of law, or would the court strike it down?
Sir, the international law on nexus is, attribution and nexus are two different aspects. Once you have a nexus, what should be attributed to that nexus will depend on the domestic formulation of law. So technically, even it is very unfair. That is the way it is. Sometimes it works that way. So the treaty will have to, unless the treaty is able to say reasonable profits attributable to the functions which are performed in the other country, which will give a little amount of scope limitation. Given the limitation that if there is an excess, I may say with my experience, in indirect taxes for a moment, if there is an excess, the whole of the sale gets taxed.
Yeah.
We can't say only the thinnest of nexus, even the slightest of nexus, if it is found, and that's a lawful nexus which has been found, then the attribution becomes a little wider. So attribution rules are generally left to the domestic law. The nexus is left to usually international understanding. But here we may need double requirement. One, nexus should be internationally understood, and even attribution needs to be internationally understood. To that extent, possibly there is a limitation in the domestic law. Sometimes what happens, you do posturing. You make the net so wide so that the agreement, when you strike a DTEA, you know the domestic law scope, which is much wider than the DTEA. So you know what to negotiate with your treaty partners. So I will leave it to my good friend Mr. Akhilesh to comment why the domestic law is always wider than the treaty.
Akhilesh, you would like to comment, or? Okay, Srinivas ji.
You're on mute, sir.
Okay.
So the domestic law must always try and capture the maximum amount of tax base that it can attribute to itself. Treaties are essentially a dilution or a compromise arrangement where each country gives up some of its taxing rights. So first of all, there must be a taxing right created in the domestic law. And then the question of treaty comes in, and where the compromises are made, some rights are given up, other rights are acquired. That's the process of negotiation. But it follows that, in the first place, there must be a taxing right, and that must come from the domestic law, and that's why it must always be broader. On the SCP part, absolutely right. As Rashid Bhai is saying, constitutionally valid or not, to my understanding, the words and the law as contained in Section 9 on SCP is supposed to be complemented by separate and clear attribution rules. These rules were attempted, draft rules in fact were framed sometime in 2018. They were put out in public domain also. I know many of you all have commented on them. These rules required a sort of an attribution based on several factors, including sales or number of employees, on the asset values, and the number of users. All that is supposed to come in some way or the other in attributing the profit. The problem came because the government decided that while the OECD discussions are going on, we will not come out with any new rules on attribution. Let's wait for the consensus to develop. And that's why we have what we have right now, a bare provision in the law on SCP with no accompanying attribution rules, which, as has been brought out, is extremely vital for the operation of that provision itself.
Akhilesh ji, thank you. but I have a query for both Akhilesh ji and Srinivas sir. Since, as Srinivas ji has explained, the whole of the exports by India and whole of the imports by India of goods and services create an ACP in India for the non-resident trader with us. Okay. Let us say there are 1 million people who are buying goods from India, another million of people who are selling goods to India. Now these 2 million people will become SSCs under Income Tax Act, because primarily they are liable to Indian income tax provisions. Then under double tax avoidance agreement, they can claim that I have no permanent establishment, so I am not liable to tax in India. But for claiming treaty relief, first they will have to give a tax residency certificate. Then they will have to establish that no, I am not liable to tax in India. So these 2 million more income tax returns, or whatever is the number, 2 million or larger or smaller, those people will have to submit their claims for treaty relief in India. Will it be really practical, or would people like to do business with India?
No, let me respond to that, Krishnan bhai. It's not 2 million. In fact, every multinational will have a nexus. We are aware of the thresholds that have been placed with the government for SEP. It says if you have more than 2 crores worth of sales.
Yes.
Now, almost every company dealing with India will have sales of more than 2 crores. Whether it is capital goods or retail goods or distribution models or regular import of models or whatever. But then I don't agree that merely because you satisfy the nexus rule that you are liable to tax in India. As previous mentioned just some time back, there are 2 very separate concepts: nexus and the income which is taxable. You may have a nexus, but no income taxable in that country which is allocable to that nexus. So merely because there is a nexus does not mean that 50 million people have to now file returns in India. I think that is not envisaged and should not be the position that is understood in law. And that's why the attribution rules are extremely important. In my personal view, the SEP provisions are in fact non-functional till such time as proper attribution rules are formulated to support them. So it's not, it hasn't. I mean, till if that was the case, then people would have started filing returns from assessment year 1920 onwards. So that's not intended.
Correct. That is not the intention of the government, but that is the law. Because the law provides for nexus, and then there is an attribution rule is not that, but the law is there. So whatever is your income, normally under a permanent establishment, the old kind of permanent establishment, it was for the SSC to compute the taxable income. He would make attribution formula. He would attribute certain income, and then the income tax officer may accept it, may reject it, and then there will be a discussion between the two. So somebody can say even if attribution rules are not provided, it is the SSC's responsibility to file the return or claim and then chartered accountants will have a lot of work, because all those people will have to file form 15 CA-CB. They will have to give a CA certificate that the payment made by Indian resident is not subject to tax and all kinds of things. I mean,
we will have, so progressively the government, my own sense is the government will remove the withholding requirement going forward. It will not be too early now. Once the attribution rules are properly framed, so those who are not known to the company, the enterprises which is selling goods in India, each of the payers may not know the attribution rules which would apply to the enterprise. Possibly over a period of time, the withholding requirement in respect of attribution SEP may be removed, because otherwise it's cumbersome. You don't have to deduct out loss amounts and then
Rashid bhai, if I could add a couple of comments over here. I think the whole focus of Pillar 1 has been on the digital, but as we know, over the period, the scope of Pillar 1 has expanded beyond digital to even include the consumer-facing businesses, and therefore it covers digital as well as the traditional sale of goods. So that's the scope of Pillar 1. Therefore, possibly the scope of significant economic presence (SEP) could be modified in line with the final understanding that emerges around Pillar 1. That could be the possibility. And just one silver lining, we've had the concept of business connections since 1961, which is of course very wide as well. Thankfully, we've not seen a we've seen a sort of reasonable application for filing of the, or at least the practice of applying the treaty benefit. So that's just a silver lining.
I agree. Yes, sir. With that, Amiyaji, now the latest tax proposal on digital assets, virtual digital assets. Would you please share some information and some knowledge on this VDA?
Sure. Thank you, Rashmi Bhai. I think this has been a biggest surprise in this year's budget, the taxation of virtual digital assets. Just to set the context, the country has been awaiting and grappling around the regulatory issues, but I think as a first step, we have at least a clarity around the tax law. As Akhilesh ji commented some time ago, I think the domestic law would want to cast the net wide, as much wide as possible, and perhaps a similar philosophy has been adopted while taxation of virtual digital assets as well. There are 2 or 3 key aspects. One is the definition, the second is the rate of tax, the third is the manner of calculation of the income, and fourth and the most critical thing is the withholding tax or the TDS. As we all know, the new law kicks in from 1st April 2022, that is the current financial year, and any income from transfer of a virtual digital asset is subject to a flat 30% tax. So that's one key change. And how do you calculate income is your sale price minus the cost of acquisition. And I think during the debate in the Lok Sabha, the finance minister clarified that even in the context of cryptos, for example, the cost of generation of the crypto or cost of harvesting, as they call it, possibly is not eligible as a deduction as well. The other critical point, and which goes slightly against the tenets of real income theory, is that the loss from crypto cannot be set off not against any other income and not even against the crypto income as well. So if you have a income from crypto 1 and a loss from crypto 2, even that cannot be offset. The loss needs to be completely ignored and the income is taxable at a flat 30% tax rate. Receipt of virtual digital assets by way of a gift is also taxable at your normal tax rates under section 56(2)(10). So that's again sort of a key change which is there. Now I think it is important to understand what is the definition of virtual digital assets. In a common sense, we thought that the law intended to cover only the cryptocurrencies as popularly known. But the definition as inserted in the Income Tax Act is very, very wide. There are 3 clauses, and clause A, for example, covers several limbs. In fact, I counted the word "or" has been used almost 10 times in clause A, suggesting as wide possible meaning as it can be. And it does have therefore some unintended consequences as well. I'll touch upon that, but I think this definition of VDA has been borrowed from the draft crypto bill which was presented in 2019, and it was supposed to come in this parliament session as well. So I think, to be fair to the tax department, they have sort of borrowed this definition and have improvised on it as well. So that's one key aspect. The second aspect around non-fungible token is again very, very wide. The second part in this definition of notification by government perhaps was not necessary, because a day will come where you will have thousands of NFTs created every single day. We don't need a notification from government on this aspect. Again, to be fair, here government has taken a power to exclude certain digital assets. Now, I'll come to the wide interpretation. The way the language is, even the shares held in a dematerialized form can form into the definition of virtual digital asset. But perhaps it is not the intention, and I think the FAQs that ministry is working upon should clarify some such exclusions. There have been apprehensions around credit card points and so on and so forth. So I think we will see a clarity on this very soon. And the next point is around the withholding tax or the TDS. So 1% TDS is applicable on the crypto transactions, which is very, very critical. I think here there's a apprehension as to transactions which are undertaken through a crypto exchange, where the identity of the buyer doesn't know who the seller is and vice versa. So how do you give effect to the TDS provision? And again, I think to be fair, the initial informal sort of conversations suggest that the responsibility will be put on to the exchanges. So this is a broad taxation framework for virtual digital assets. By and large, it is wide in scope. I think I'd like to touch upon very briefly on the non-resident aspect as well. So if a non-resident which is holding a crypto asset in India, we don't know how many such transactions exist, but let's say theoretically there is such a transaction that is carried on. The treaty benefit will still come into picture in my view. Here, if a virtual digital or a crypto transaction is in the nature of a business, whether such a non-resident has a PE or not will be relevant, number one. And number two, if it is like a capital asset, then depending upon the treaty, the capital gains article will come into picture. A treaty like USA is very wide, and the capital gains are entirely allocated to the as per the domestic law. But many other treaties, say Singapore, Netherlands, by and large, one will be able to take a position in respect of VDAs that they are not taxable in India. So I'll take a pause over here, Rashmin bhai. Over to you.
Thank you, Amiyaji. Can I make one or two observations? When an Indian resident, he has got, let us say, cryptocurrencies either in an Indian wallet or a foreign wallet, and he does any transaction, okay, then he is liable to Indian income tax on his global income. Correct. Now, let us say there is a non-resident. Generally, he would have his crypto assets outside India, but in case he has a crypto asset in India, then prima facie, as per the tax provisions of VDA, the transaction occurs in India, and hence he may be liable to tax in India. Then, as you have rightly said, if it is a business income for him, then one will have to see whether it will fall under PE or SEP. And as we have just now seen, SEP provision is so widely worded that every transaction will fall within SEP. So then he may become liable to tax in India. Okay. But SEP and the treaty, the conflict between the two, because SEP will be the Indian Income Tax Act provision, the treaty provision may be much narrower. So that is where the non-resident may have a grace. And when you have also referred to capital gains article, now in capital gains, shares and securities are treated separately, immovable properties are treated separately, and all other assets, normally the right go to COR. So if a non-resident earns VDA capital gains in India, still he may not be liable to Indian Income Tax Act. Would you like to comment on that?
No, sure, Rashmin bhai. I agree with you on that proposition.
Sir, then I'll take a sec. Yeah, please. Sorry. Go ahead, Amiyaji.
No, so just one point. I think even before the budget came in, virtual digital asset, any income from that was taxable per se. Yeah. So I think it's a misunderstanding that they were earlier not taxable, so to speak. It was a question of whether it is business and therefore 30% or capital gains and 20%. And of course, the losses were available as well. So that's one small point I wanted to clarify.
Sir, you are right, absolutely. It was always taxable as far as Indian resident was concerned. Now they have put up very stiff provisions. Now, the kind of stiff provisions are there, it is very clear that India wants to discourage crypto assets and NFTs. Okay, because when you put 30% tax on a flat transaction, you do not allow so many set-offs and all that. It is like a sin tax. as we government of India has got tax on cigarettes and wines, and but my point is, Indian Income Tax Act, the purpose of the act is to collect revenue. Now, if government does not like crypto asset, then government's job is to bring a separate law to regulate crypto asset. What they are trying to do is discourage crypto assets and NFT through the Income Tax Act. Sir, if you remember, all the panelists are senior here. Under Section 80 HSC, to encourage exports, there was 100% exemption under Section 80 HSC for export profits. Now, that one provision had given chance for so many frauds, big frauds that happened and that shook up the share market also. Okay. So, my point is, when through the Income Tax Act, government tries to achieve extraneous objects, it always creates problems. I would request any one of the panelists, Akhilesh ji, Srinivas ji and Amiya ji, or Mr. S.P. Singh also, if you would like to make comment on these extraneous objects.
Rashmi, I have one observation.
Yes, sir.
Whenever we look at the way the law is framed, we find that the purpose of framing a law is to either bring something under the tax net. Because India being, a developing country, we always wanted more foreign exchange to come and to enable but when the tax law is framed, for the first one, we always want to keep the basket as big as possible or the net as big as possible and for the as possible. In spite of that, there are leakages or things like that. But the most important thing, for your consideration is that, there are two things happening. One is that we are framed to it, way of conducting the business or the future way of conducting the business with the, the treaty laws which are of 1920. So many of the basic concepts
Sir, your voice is cutting out.
Tax treaty. Don't you? So don't you think that our DTAAs do not allow to have a very wide scope of domestic taxation? In spite of that, the moment this income, you will have to go to Article 7, Article 5, and like that.
Singh
And
sir,
there will be
if you can put up your video, probably we will be able to listen to your audio. आपका इंटरनेट कनेक्शन थोड़ा पुअर है, तो if you yes, now if you
am I clear now?
Yeah, we can hear you now.
Rashmi, what I was trying to emphasize upon
Yes,
that whenever the tax administration frames law, it tries to keep the net as wide as possible to bring more and more item or the wider scope of the income within the tax net. So far as the benefits are concerned, one tries to keep it as narrow as possible so that there may not be leakages. In spite of that, both the things happen. But when you look at the implementation, the domestic law is to comply with the tax treaty laws which are of 1920s. So don't you feel that even the law which has been made for cryptocurrencies or crypto assets, the moment we call it business income, it will have to climb a huge wall of Article 7 and Article 5.
Correct. Singh Sahab, I 100% agree with you that the treaty model is outdated in several respects. Permanent establishment being an outdated definition is a very very well known and discussed issue. But even otherwise, the entire treaty model, in my view, is an outdated model. It gives far more taxing rights to the country of residence and far little right to the country of source And country of market, in fact, under the existing structure, country of market has zero right. So the treaty model needs a rewriting from the drawing board stage. Completely it needs rewriting. I fully agree with you. But, sir, the virtual digital assets are largely, this tax is applicable to Indian residents. Even if you are doing a cryptocurrency transaction within India, you pay up the 30% tax. So the treaty issue will be little less in case of VDA.
Sir, can I make a comment?
Yes, sir, please.
Sir, sin tax possibly generates a lot of revenue for the government sometimes. For example, cigarettes do generate a lot of revenue. Alcohol also drives many economies, though that's not the right way to drive. That may be our moral justification, but in reality, alcohol generates a lot of economies. I think if I have to suggest that the government must possibly, these are all only loud thinking, if they are, sometimes we can present it to them, they must augment VDA trade. The exchanges should be headquartered in India. Globe must look as India as the headquarter for the exchanges. That will enable capture of information. The value of trade itself will generate an economy in itself. The taxes which are associated with also will come a little on that. So sometimes we have to think whether the 30% tax is a deterrent that will drive away even the economy which otherwise would have come. So the trade-off between the rate of tax and the way you want to develop a business, that would determine the intent of the government. If the government says 30% tax, and that possibly is a signal that we don't want VDA as a business activity in India, we will, of course, if you still want to do it, we'll tax you heavily. That can be one. But you can say even a 5% tax with global trade exchange happening in India for VDA, possibly you will be able to collect more revenues, but with a nominal rate of tax. Now, this is a policy. If there are apprehensions which are beyond my comprehension, that is money being used by, currency being used by illegal activities and so on and so forth, those are all different. But if it can be regulated, possibly we should headquarter the VDA exchange in India and have the transaction routed through India. In fact, last one of the conferences on ICA only, we did make a mention that Nifty 50 has gone out to Singapore now. Nifty 50 is a stock on Indian stock exchange, but it's actually traded in Singapore more than in India. So you find that the economic benefits of a particular activity has gone to Singapore, while it could have been very well retained in India with a better capture.
Sir, I would submit that your this suggestion, very pragmatic suggestion, applies to the whole of the law. If the law is liberal and encourages businessmen, we will have more business in India. That itself will generate more tax revenue in India.
Yeah,
and when the law is
we also should not result in an economic like Sri Lanka, where they have given up many taxing rights and they are in problem.
Yeah, you are right, sir. Okay, sir. Now we have about 20-25 minutes with us. So we go to the comparison of, because this was our intention, that out of the several provisions applicable in India, what will be the correct provision? How will the SSC determine? So, sir, here we have presented a small, very simple case study, actually simplistic case study, but the idea is to throw light on what provisions will be applicable. So, first is a comparison of Pillar 1 with IT. I think this still is just a comparison. We would skip it in view of the time available. Now we come to hierarchy out of these 4 different provisions within the Income Tax Act. So if we discuss when the treaty will be applicable, and if the treaty is not applicable and we are talking of the Indian Income Tax Act provisions, then out of these 4 provisions, which would be applicable? So first of all, OECD statements are still not binding. They have not become part of the Double Tax Avoidance Treaty. So for a moment, when we come down to the practical brass track, we can ignore the OECD statements. Okay. And that means that the existing Double Tax Avoidance Treaty, which I think all the four panelists have said, is outdated. It does not provide for any digital taxation, and that is valid today. Which means if India is a country of market India will have no taxing right under the treaty, and I think probably 99% of India's cross-border business will be covered under the treaty. So for the time being, people can ignore Pillar 1 and Pillar 2. And then we go to the Indian Income Tax Act provision. Virtual digital assets is the first law we may consider, and as long as it is matter of Indian resident, then we do not talk of treaty, because Indian resident will be liable to tax whether the crypto transaction is conducted in India or outside India. And then the tax provisions are very hard. Person must study his, before he conducts any NFT transaction or crypto transaction, he should know that he is exposed to a very high tax liability. Not a one chapter. There is some disturbance from somebody. You are not speaking. If you can silence your audio. Thank you, sir. Thank you. Now, so these provisions are all applicable under the law today, meaning the provisions which are incorporated within the Income Tax Act are all applicable today. So now let us see which provisions will be applicable. Now, as the government has presented the issue, equalization levy is outside the Income Tax Act. It is not a part of the Income Tax Act. Hence, government's view is that the double tax avoidance treaty does not apply to EQL. That is the whole purpose. Because if the treaty would be curtailing the equalization levy right, then it would not serve any purpose. The whole purpose was, yes, equalization levy is applicable today. Now, we professionals have been arguing about it, but I am told the SSEs, the multinational corporations who have digital commerce income, they are paying up the tax. So there is very little litigation on this subject. Okay, now within equalization levy, we have got two equalization levies. One which became the law in 2016 and the second which became the law in 2020. The 2016, the tax is 6%, but it is restricted only to advertisement revenue. And the second equalization levy, the tax is at the rate of 2%. Now, let us say we are considering the income of a non-resident. If he has a permanent establishment in India, a permanent establishment, the traditional style other than ACP, then the non-resident is always liable to tax under the normal treaty as well as Income Tax Act, and 43% of net profit will be taxable. I mean, 43% will be the tax rate on profits attributable to PE. That is Section 911 explanation A. But let us say there is no permanent establishment, like most of the digital corporations, there is no permanent establishment in India. Then what happens? So the first proposal which we have put up here is applicable probably to a really insignificant level of business. The second proposal is more important, and there we have got a few different observations. Some transactions are such that the definition of royalty or fees for technical services can be applied. And as we have seen, when the CBDT drafts a law, the definition is always very wide to cover as much as possible. So it is possible that many transactions would be covered under royalty or FTS. So if it is covered under royalty or FTS, then pay tax as per the treaty rates. If there is no double tax avoidance agreement, then under Section 115A, tax at the rate of 10% on the gross revenue will be applicable. So that is the first clear guidance to the SSE. If royalty is applicable, then pay tax at the rate of 10%. If equalization levy 2016 is applicable, pay tax at the rate of 6%. If equalization levy 2020 is applicable, pay the tax at the rate of 2%, again all gross revenue. Now, if the person non-resident falls in the definition of ACP, then he is deemed to have a business connection in India. But under the treaty, this would not be covered, as we have already seen, so he will not be liable to pay tax. Now, those very few countries with which India does not have a double tax avoidance treaty, if the non-resident is resident of such country, then he will be subject to tax, and the profits attributable on that he will pay 43% tax in India. And we have seen that in my submission, ACP provision is unfair in the sense that the whole of the profit, once a nexus is established, the whole of the profit will be taxable in India. So probably, in today's times, the tax provisions are so harsh that if somebody is considered to be a defaulter under income tax law, the consequences are far harsher than payment of tax. So the simplest guideline is follow the highest rate applicable. I mean, if you are not subject to tax, very good. Once you are subject to tax, probably it may in some situation just follow the highest rate applicable. Now that may make the whole business unprofitable. It is possible. This is just an observation that we have seen that digital technology is progressing at a geometrical progression rate. Very fast rate. Every 2 years we see a quantum change in the technology. With technology, business models, new and new business models keep coming. Now OECD has taken 23 years just to come out with a crude proposal on digital taxation, and quite likely in the year 2025 we will see some business model which have not been even envisaged by the tax consultants of today, by OECD of today. Then probably OECD will take another 23 years to draft a tax law. God only knows. Friends, depending upon time available, now we will see a few case studies, very simple case studies. Let us say one Indian resident pays to a non-resident for online purchase of goods. The non-resident can say that he has sold goods to Indian resident. There is no permanent establishment. The rules of definition of FTS and royalty do not apply, and hence these three provisions are not applicable. However, equalization levy, the 2020, or one can say 2% levy, is very widely worded. So it may be applicable in many transactions. The saving grace here is the Indian resident payer. I'm sorry, there is a typing error. Indian resident pay is incorrect. Indian resident payer is not concerned because he has no responsibility to deduct tax at source. It is for the non-resident to pay the tax. It is his responsibility. Section 195 does not apply to EQL because EQL is outside the Income Tax Act. And wherever there is a treaty, ACP will not be applicable. So in this simplest of the case study where a non-resident sells goods online, probably none of these provisions will be applicable. Now we consider, any of the panelists, sir, would you like to make any comment on this case study one?
Nothing, sir. I will possibly request you to proceed with that.
Thank you, sir. Then I go to case study 2. Here there is an Indian resident who is provided services online. Okay, so the moment the services are provided, probably section 917 for the fees for technical services may be applicable. Of course, a lot depends upon the facts of the case. But in case FTS is applicable, and assuming that it is a matter pertaining to India-US double tax avoidance treaty, then the treaty contains the clause of make available. Now, most of these online services, like say somebody is watching an entertainment, there is a film to be watched or a music to be heard, and all these cases make available clause will not apply. Hence, under the treaty, the non-resident will not be subject to income tax. Since he will not be subject to income tax, Indian resident will not be deducting any income tax at source. However, he may have to submit the CA certificate and submit those forms 15 CA CB to say that okay, he is not liable to deduct tax at source. In case of advertisement, I mean, since it is an online service, it may cover advertisement. If it is, no, sorry, in case of other equalization levy, the second, if that is applicable, the 2% rate will apply. The non-resident will pay 2% tax. Indian resident payer has no responsibility at all. And once, if it is covered under equalization levy, then under section 1050, rest of the Income Tax Act provisions will not be applicable. Now, this is a comparison of some provisions. Sir, anybody would like to make any comments here?
If it is a case of FTS or royalty, that needs to be understood.
Yes, sir.
Instead of FTS, if it happens to be a royalty, still we have to consider that alternative also. So here, certain examples, no doubt certain services which you have possibly spoken, some of them are automated services where there is no human intervention. So FTS may not apply, but certainly it may trigger a royalty in certain circumstances. So the distinction between FTS and royalty has to be still made. I think that would be an important point which I thought I'll find.
Yes, sir. Yes, sir. Any other comments?
Rashmin bhai, would like to add one comment here, more at a practical level. Here, of course, the design is right that, for example, in this case, the non-resident may assess this to be subject to equalization levy. At times, as a payer, at the time of withholding, I have to take certain position which subsequently is disputed by the tax authorities. So let us say I take a position that this is not a royalty, this is not a fee for technical service. But let us say under the contract, the tax liability, any additional tax liability is upon me. I always run a risk of later on tax department coming after and challenging this position, and especially given the way the precedence is given that royalty FTS will prevail over the equalization levy exemption, this risk always looms large, particularly on the Indian payers, and this is something which is a significant risk, particularly for the medium to large, small medium payers as well. Just wanted to make that comment, Rashmin bhai.
Amiyaji, I fully agree with you. In fact, I'll go a little step further while being fully in agreement. Even large MNCs, you see, they have larger transactions. A large, let us say a large Indian corporation is obtaining lot of online services. Its values will be larger, and then when if it is exposed to TDS, quite likely sometimes TDS may be more than the net profit ratio also. So when the government drafts every single provision very widely, whether it is royalty, whether it is VDA, whether it is SEP, you draft every provision very widely and then expose the Indian resident to all these consequences. Sometimes it becomes very difficult.
As recently in February, the Delhi High Court happened to deal with a very interesting issue. Possibly it has missed our attention because it was an interim order. It was a case where EL was paid at 2%, and the Delhi High Court said that 115A applicability was the question, whether it will be royalty, FTS. Delhi High Court said pay 8%, 2% has already been paid as EL. So essentially it's disputed whether the 8% is only a pre-deposit. Final conclusion will have to be made a little later. But some reconciliation that the total will not exceed 10%, I think, and the shifting of responsibility also. If it is 115A, possibly it is a party which has come in for put it across saying that I am the recipient, I am the one who is liable to EL. I say nothing else is liable to me, and therefore it's not royalty. So the dispute has been centered around the payee, and possibly the payer has been removed from the hardship.
Thank you, sir. Thank you. We look at the next one. an Indian resident used web services provided by the non-resident. Now we are just taking a case where treaty is not applicable. So one of the countries with which India does not have a substantial treaty is British Virgin Islands. So since the Indian resident has used web services, Section 9 will apply. It will be covered by royalty, generally royalty, it may be FTS. Then he has to pay TDS at the rate of 10%. If it is not a royalty, then probably equalization levy will apply, in which case the Indian resident has no responsibility. It is for the non-resident to pay 2% tax. Now in all cases, SEP applies because it is so widely worded. But once equalization levy applies, then under section 1050, SEP will not be applicable. Now the highlighting of the issue is, since there is no treaty, the non-resident will be subject to tax in either one provision or the other, and these provisions, some of the provisions are not restricted to digital transaction. It is open for every kind of transaction. On this case study 3, anybody would like to make any comment or observations?
Nothing, sir.
Okay, sir.
Rashmi bhai, just one suggestion or one comment over here, and
Yes, sir.
taking a cue from this case study, slightly the way Pillar 1 finally moves out, nobody knows, and we know the outcome of Pillar 2 will be restricted to the top 100 large corporates, and as an outcome of Pillar 1, there is a commitment by the countries to withdraw the unilateral measures. So what is not clear is that what happens to the next 1,000, 10,000 multinationals which are smaller entities which are below the threshold, and would they be subject to still this sort of constant debate on equalization levy versus withholding tax? And I think there some clarity will be very, very helpful, and the specific suggestion therefore is that for such entities, if government wants to tax it as royalty or FTS, perhaps reduce the rate of tax to a more moderate level than a gross rate of 10%. That's a suggestion, because beyond Pillar 1 companies, the issue is still going to stay with us for some foreseeable time.
Miyaji, you have raised an important point, and here may I make another observation. The Pillar 1 is for giving taxing right to country of market, and there the threshold is 20 billion euros. I think it is a historical record. Okay, to make an SSE liable to tax, let us say in India we have an upper limit of 2,50,000 is the exemption limit. If you have more than that income, meaning probably $3,000-4,000, then you are subject to tax. In case of SEP, we have got 2 crores threshold, which is again a small amount. But talking of 20 billion euros as the threshold is something unheard of. Probably the attempt is to really, in reality, the Pillar 1 is frustrating digital taxation. Meaning, you will be taxing only 2 or 3 corporations or 10 corporations around the world. But while taxing those 10 corporations, you are supposed to withdraw equalization levy, diverted profit tax act, and every other unilateral digital tax law. So probably if I understand, once you withdraw equalization levy, then whether it is large corporation, small corporation, everybody is exempted from equalization levy. Amiyaji, any observation, or Akhileshji, any observation on that?
No, I agree with you that once the new Pillar 1 mechanism is implemented, then the equalization levy has to be withdrawn. That is a commitment that India has made, and it will be withdrawn for all companies, even though the Pillar 1 will apply only to about 100 multinationals all over the world. But yes, that appears on the face of it to be an extremely unfair solution. But I think what the government has been looking at is at the future, that it is preferable to have a consensus solution which can be limited at this point of time, but which may grow and be more applicable in the future. We do see the thresholds coming down in the future. The agreement itself says that after 7 years, the threshold will come down to 10 billion. More and more companies should be getting covered. It's also a fact that about 200 odd companies, multinationals in the world, contribute to about 85% of global corporate profits. So there are many considerations which the government has kept in mind while agreeing to this seemingly unfair situation. If you look very closely, that may not really be so unfair. It is a forward-looking sort of compromise. It's also another consideration with the government of India is that very soon, maybe in 5 years, 10 years, India may also have large multinationals headquartered in it. And then the issues of source versus residence will get sort of turned on their head. It is then we have to see that should India be losing out on profits in the future, 10 years or 15 years ahead. All those are various considerations that maybe you've seen. So while it does appear unfair at the moment, I think there are many considerations which the government has been keeping in mind while agreeing to it.
Thank you, sir. Thank you. We may briefly consider crypto coins. This actually we have already commented that if the non-resident has a crypto coin in an Indian wallet, if he sells it in India, then prima facie under Section 5, the income on sale accrues in India, and this income prima facie would be taxable whether VDA chapter is there or not. But since the non-resident may not have a permanent establishment in India, then under the treaty he will not be taxable. And this observation we have already made. Foreign training services. A lot of this has become very popular. Indian residents are taking training services from abroad. So there is an Indian payer, equalization levy 2 applies. It may be covered also by royalty and FTS. If it is covered here, then the tax will be higher. If the training is provided from a country where treaty is not applicable, then of course that royalty benefit will go away. I'm sorry, there is an error here. The equalization levy is not subject to treaty, but it is a controversial issue because Section 1050 Explanation 1 is talking about chargeable to tax for the foreign training services. On foreign training services received by an Indian resident, would any of the panelists like to make any comment?
It will escape taxation on multiple counts because we have to see who is the person who is receiving the services. If it is B2C for a moment, then for equalization levy will not apply. It will apply only to a business context, if I have to say. And the 195 does not abate because it's B2C, but the enforcement mechanism is just not there for a B2C kind of transactions. So you'll find it may fail on multiple counts because of administrative reasons or lack of ability to implement the law. But if it is B2B, then it becomes very easy because it would be a case of FTS because training services would impart knowledge, and imparting knowledge would automatically have some tones of make available. So even treaty escape may not be easy. Domestic law, of course, is very wide. Therefore, I would say it would be a fit case for TDS, and therefore EL and other things may not have to be looked at. Any other panelist certainly can overrule my observation and give better thoughts.
You have made a very good observation, sir. Thank you. Any other observation from the panelists or from Mr. Singh? Okay. Then I will just submit the last slide for today's presentation. I'm submitting that a lot of Indian tax professionals, whether professionals or even tax officers, have this weakness of trying to interpret the law. But if we look at the entire truth behind this pillar 1 and pillar 2, then probably the whole subject becomes simple. To me today, this e-commerce tax or digital tax, everything looks very simple, whereas most people find it difficult to understand it because there is a mindset. And the mindset with the old theories is there because OECD has drafted the treaty in such a manner that the rich countries get the maximum right to tax, the developing countries get the minimum right to tax. And I will end my presentation with the statement that OECD is an institution of the rich, by the rich, for the rich. With that, either if any of the panelists would like to make any comment, otherwise we'll give it back to the institute.
Rasmin, I think it will be good if you can address, because there are a couple of questions from the
Yes, sir.
audience.
Yes, please.
Regarding, so far as the crypto assets are concerned, the transactions, whether they will fall under the gamut of business income or capital gains. If capital gains, then which method of valuation may be adopted. So if you can throw any light on that, or any of the panelists, that will benefit them.
I'll make my initial submissions that prima facie VDA is targeted for Indian SSEs, Indian resident SSEs. So for him, the law is very clear. The tax rate is 30% of the net profit. And net profit only means the sale price minus cost of acquisition. And if I sell one kind of coin, make a profit, I make another coin transaction, there I make loss, there is no set-off available. So this is my initial observation that yes, crypto tax will be payable by an Indian resident. If it is a non-resident conducting transactions in India, I think it is a very rare situation. But if it so happens, because there are many non-residents who want to take advantage out of the arbitrage available in India. The arbitrage is that Indian crypto prices are little higher than the international prices. So they purchase from abroad and then they sell in India. Now when they sell in India, they will be exposed to Indian tax liability, and then the treaty provisions will come into picture. They may not be liable to tax because of the treaty. Because Mr. Amiya has made little more in-depth study of VDA. Sir, would you like to make any comment on this query from the participants?
Sure. So, Rashmin bhai, just continuing your thread, for resident, it really doesn't make much of a difference regarding the head of income because the outcome is still the same. As far as the non-resident is concerned, the classification, the manner of classification was between business and capital gain will have a bearing on the treaty outcome definitely, and there is no single straightforward solution. We've seen that even in the context of FIIs, there was a debate on whether the income is business income and with no PE, no tax versus capital gain, and it would therefore depend on the facts of the case. Even in the domestic context for shared transactions, we look at various principles to decide whether I am carrying out the activity as an investor or a trader, and the similar spirit and the principles perhaps will have to be applied. Needless to say, this will be a subjective and therefore a potentially litigative proposition.
Correct.
Thank you. Thanks, Amir. Thanks, Rashmin, and real thanks to all the panel members. The best part today, and which I must appreciate all of you, is that you all started talking about the basic issues, and then you try to find out solutions for the complex questions which are coming up because of the development in business and the consequential aspect in respect of taxation. All the issues which you have discussed, I think they are present and future. So a lot of I think developments, even the tax authorities will need to have proper training, the chartered accountants, all the advisors, because we need to look how the world is moving ahead. Whenever we bring in such type of forward-looking law, it is always work in progress. And how we go about it, how we try to, you know, enlighten ourselves, enrich ourselves in respect of knowledge, will determine how the world will look at us about so far as the implementation is concerned. There are challenges, which have been rightly brought out, but the solution have to be found, because no country will like to lose revenue. At whatever cost. Whether the source rule need to be amended, because, or the residence rule need to be amended. The world will have to look at it. If some multinationals or some countries are going to be benefited, that will not be a good solution for the global development. So I think, I'm sure all the participants must have been immensely benefited. And this webcast will be available, on the same link on which you have joined today. And it will also be available on DLH portal. So you can always listen to the panelists, take questions, and you can ask them. They are always available. So many seminars are being held. You will find one or the other of them present. You must use those occasions to sharpen your intellect, to grow your depth of knowledge. Last but not the least, I would like to thank the secretariat, led by Mukta, and at the end, and the ICAI for organizing this, and for all the four panelists for taking time out, because they have put in a lot of labor. I have been witness to that. It's a real work which has labor, which has gone into the nice and the crispy presentation which all of you have listened to it. Let us give them a big thumbs up, and thanks to all of them. Thank you.
Thank you. Thank you.
Thank you. Thank you very much.